VEQ, VGRO, VBAL. 3 tickers, 1 decision, and half the Canadian finance internet argues about it like it's a hockey trade. Here's the secret. The funds are nearly identical. The real question is about you. How much of your money can you watch drop without hitting sell? And there's a mistake people make when they pick their answer, one that quietly costs more than any fee I've ever complained about on this channel, and I complain about fees professionally. It's coming later. First, the 2-minute version of what these things actually are. Quick credibility check. I own this exact fund family, and the first time I picked one, I picked wrong. Not because I misread a chart, because I read it on a very good day. Hold that thought. Each of these funds is basically the entire stock market in a shopping bag. Thousands of companies from Canada, the US, and everywhere else wrapped into one ticker that trades in Canadian dollars. And it rebalances itself automatically, forever. You buy one thing and a very patient robot at Vanguard does all the boring maintenance. It's the slow cooker of investing. Set it, leave, come back to dinner. My old approach was 5 ETFs, a spreadsheet, and a quarterly rebalancing ritual I abandoned every quarter. One fund made me the investor my spreadsheet always assumed I was. The only real difference between them is one dial: stocks versus bonds. VEQT, $10 out of every 10 in stocks. VGRO, 8 in stocks, 2 in bonds. VBAL, 6 in stocks, 4 in bonds. That's it. That's the entire family feud. Bonds, if you're new here, are the boring roommate of your portfolio. They don't grow much, but they pay their rent on time and they calm the whole house down when the stocks are throwing furniture. Yes, Canada gets a bigger slice of these funds than its share of the world market. That's deliberate. Proportion, not exile. And the fees? Cheap. A small fraction of what my old bank mutual fund charged me while handing me a free pen. That's the whole product. Explained? And no jargon survived. That's what I do here. Honest Canadian money math every week. Subscribe if that's useful. Now, which dial setting is yours? This is where most guides hand you a risk questionnaire. I'm handing you a mirror instead. 3 people. Find yourself in one of them. Person 1, retirement is decades away. For you, a market crash is a grocery store sale. Everything you were going to buy anyway, suddenly marked down. You don't need a cushion, you need decades, and you own a warehouse full of them. That's the all-stock temperament, VEQT country. Person 2, the money has a job in about a decade. Retirement, maybe a house. Drops stop feeling like sales and start feeling like turbulence. $2 in 10 parked in bonds keeps you from refreshing the app at 3 in the morning. That's VGRO territory. Person 3, you're drawing income from this money now. The question isn't growth anymore, it's sleep. With $4 in 10 sitting in bonds, a bad market year doesn't rewrite your grocery list. That's the VBAL temperament. So here's the honest sorting question, better than any quiz. Picture 100 grand of your actual money on a screen in a genuinely ugly market year. All stock drops hardest and has historically recovered strongest. Balance drops less and climbs slower. Which screen can you look at without selling? That's your fund. Which brings us to the mistake I promised at the start, the expensive one. People pick their split on a good day. Markets are up, the portfolio's green, everyone's a genius. All stock feels obvious. Courage is free in a bull market. Then the crash shows up uninvited and introduces them to their actual risk tolerance. Live with real money. And a lot of them sell right at the bottom, then buy back in later, higher. Run that round trip once, and it can cost you years of gains. Every fee I've ever ranted about is a rounding error next to it. The most expensive number in investing isn't a percentage. It's the day you picked your split. I did a version of this, picked my courage on a sunny day, then discovered on a rainy one that I'd overestimated it by roughly one Winnipeg winter. I held on barely with the thermostat set to gilt. So my verdict, and I'll stand behind this, you cannot really pick a bad fund here. All three are cheap, diversified, and automatic. The only bad pick is the one you'll abandon in a bad year. The split you can hold beats the split that back tests best. So pick your number for your worst imagined day, not your best real one. Then buy it, automate it, and go live your life. The robots got it. Now confess in the comments, which one are you? VQT, VGRO, or VBL? And be honest. Did you pick it on a good day? If you're team all stock and torn between tickers, my VQT versus XEQT video settles that fight next. Not financial advice, just one Canadian dad who reads rate tables so you don't have to.